Stop. Put the remote control down for a moment. If you're sitting in the living room, tell your wife you'll do the dishes later. And if you're in the bathroom right now, take your phone with you and lock the door. Because what I'm about to show you is so urgent that everything else in your life becomes secondary for a moment. Over the last 48 hours, my inbox has exploded. No advertisements, no rumors from social media, but real reports. From private wealth clients, from high net worth individuals in London and New York, and even from ordinary retail investors holding larger silver positions. And every single message tells the same story. Their brokers are actively calling them. If you've been in the markets long enough, you know exactly what that means. Brokers usually call you for only two reasons: either to sell you an expensive product you don't need, or to inform you that your account is close to a margin call. They do not call you to help you find the perfect exit. And yet this week, phones are ringing nonstop, and the script they're reading is identical everywhere. Coordinated, precise, word for word the same. They are calling exactly the people who bought silver at $20, who held through $30, and who are now sitting on massive gains at $80. And they say the party is over. But they don't just say take profits. That would be normal. They go one step further. They recommend short positions. They sell put options. They promote inverse ETFs. In other words, they are urging their own clients to bet against the strongest silver bull market of an entire generation. And the language they use is not accidental. It is designed to scare. They don't say correction. They don't say pullback. They use words like meltdown, structural liquidity event, inevitable crash within 72 hours. They tell retirees and grandmothers that they will lose everything if they don't sell immediately. They paint the picture of a catastrophic sell-off that will erase all gains from 2025 in a single afternoon. Now, pause for a moment, take a deep breath, and think like an investigator. Ask yourself the most important question in finance: cui bono? Who benefits? Since when do large bullion banks care about your financial well-being? They didn't call you when silver was at 18. They stayed silent when it broke through 50. But now, when silver is at 80, when COMEX inventories are running dry, when the Shanghai spread is exploding, now they're suddenly your best friends? No. This is not a warning. This is a trap. And in the next part, I'll show you why these calls have nothing to do with protecting you, who is really being rescued, and which so-called technical event is being used as a psychological weapon to shake you out of your position. Now, pause for a moment. Let go of the fear, and ask yourself one simple question. Since when have major banks tried to gift you the perfect market exit? They didn't call you when silver sat dead for years at $18. They didn't warn you when analyst reports predicted single-digit prices. They stayed silent. But now, when silver is at $80, when inventories are disappearing, when the market is overheating, now they suddenly call? That only makes sense if this isn't about you. This is not a rescue operation. This is a bailout attempt. Because for every seller, there must be a buyer. If brokers suddenly push everyone to sell, you have to ask yourself, who needs these sellers so urgently? The answer is simple. They do. These institutions are sitting on massive short positions. And with every dollar that the price of silver rises, their margin calls grow larger. They are bleeding. And they know it. So they desperately try to create liquidity, not from professionals, but from you. They want you to give up your winning ticket so they can close their toxic bets before the market truly explodes. And to make you do that, they need fear. That's why they don't tell stories about corrections. They talk about meltdowns, about systemic events, about inevitable crashes. And the tool they are using for this is a bureaucratic event most people have never even heard of. A calendar entry, a rule, a supposedly technical forced measure. They hold this date in front of you like a loaded weapon and claim it will trigger a selling tsunami the market cannot survive. But the decisive question is this really the beginning of a collapse, or just the most sophisticated bear trap trick in decades? To understand that, we have to look closely at this very event, because yes, It exists. But the story being told about it is a deliberate distortion. In the next part, we will dismantle this narrative piece by piece and examine what this ominous rebalancing really is, how large it actually is, and why truth and lies are being intentionally mixed together here. Right now, brokers are waving a single word like a threat: rebalancing. More specifically, the rebalancing of the Bloomberg Commodity Index, or BCI for short. To most people, it sounds harmless, a technical term, just another acronym on CNBC. But for large pools of capital, the BCI is no sideshow. It is the benchmark. A gigantic passive block of capital worth roughly $18 billion, holding commodities strictly according to fixed rules. This money does not think. It does not analyze. It does not react to shortages, mine disruptions, or solar demand. It follows code. And once a year, in January, that code must be executed. The rebalancing. During this process, each position is checked to see whether it still matches its target weight. No more, no less. And yes, for 2026, the target weight of silver was reduced from roughly 4.49% to about 3.994%. This is exactly where brokers step in. They point to this document and say, the biggest commodity whale must sell. And that sounds dramatic, but it's misleading because the index is not selling because silver is bad. It is selling because silver was too good. Silver outperformed almost everything in 2025. And because the BCI has caps, anything that grows too large has to be trimmed back. This is not a vote of no confidence. It is a penalty for success. But brokers leave that part out. Instead, they sell you a collapse narrative. They throw around big numbers, billions, selling waves, collapsing order books. And yes, the rebalancing is real. The selling is real. But the conclusion that this automatically triggers a crash is based on faulty math and the deliberate omission of critical details. In the next part, we'll do exactly what they don't want you to do. We'll run the numbers. We'll reveal the real figure. And we'll show why this panic is simultaneously bigger and more harmless than both sides claim. Right now, a dangerous half-truth is circulating. You may have already read it yourself. The target weight is only dropping by about 0.5%. That's a trivial $600 million. So why all the panic? And this is exactly where the trick begins, because that calculation is wrong. But the brokers are also lying when they automatically turn it into a crash scenario. Let's clear the fog. The mistake lies in looking only at target weights while ignoring price movement. Silver didn't just rise slightly in 2025, it exploded from around $30 through $40, $60, and into the area of $80. While oil, wheat, or coffee stagnated, silver more than doubled. What happens inside an index when one position doubles while the rest stands still? It swells. It crowds out the others. By the end of 2025, silver no longer made up 4.5%, but nearly 9% of the entire fund volume. And now comes the crucial part. The rebalancing algorithm does not look backward. It looks at the current state. It sees 9% reality versus 3.94% allowed target. That does not mean a 0.5% sale. That means roughly 5% of the entire fund must be reduced. Do the math. 5% of $18 billion is roughly $5.4 to $6 billion. That is not trivial. That is a colossus. Converted into paper contracts, we're talking about 70 to 78 million ounces of silver that theoretically have to be sold. Almost 10% of global annual mine production in a short period of time. And that's exactly why brokers sound so confident. They see this number and believe the market cannot absorb it. If you look only at the selling side, you might agree with them. But this is precisely where the trap snaps shut. Because in financial markets, one simple truth applies. Volume is not the same as impact. Size does not decide. Timing and prior knowledge do. And this is the point where the entire meltdown story falls apart. In the next part, I'll show you why this alleged selling monster has already been digested long ago, what front-running has to do with it, and why the crash is, in truth, already in the rearview mirror. The banks act as if this $6 billion sale is about to happen now, as if it were a surprise, as if it were going to hit this week like a hammer. But ask yourself one simple question. If you knew with absolute certainty that a gigantic index must sell silver in January, would you really wait until January? Of course not. In professional finance, waiting is the same as losing. The rebalancing decision was published months in advance, in the fall, publicly, visible to everyone. And the moment this target weighting became known, front-running began. Active managers, hedge funds, and the trading desks of large institutions did not wait. They sold in November, they sold in December, they sold into strength while prices were still rising. Why? Because that is the ideal moment. High liquidity, plenty of buyers, very little attention. The market has already absorbed these sales. That is exactly why silver in December did not immediately explode to 100, but instead consolidated around 80. That was not weakness. That was digestion. If someone tells you today that the major selling pressure is still ahead, they are deliberately ignoring reality. So, what remains now? Only the pure passive funds that are legally required to trade on the official rebalancing day. These funds are small, maybe $2 to $3 billion. The rest is already done. And this is where it becomes clear why brokers are calling now. Not because a crash is coming, but because they want you to provide the last liquidity. They hope you will see a short-term dip caused by these passive sales and mistake it for the beginning of the end. But in reality, the robots sell at the bottom, while the professionals are already waiting again, ready to buy back cheaply. And this is exactly the loop institutions like JP Morgan Chase & Co. and Morgan Stanley want to close, with you as the victim. In the next part, we turn our gaze away from New York and look east. Because while the West argues over paper, there is a buyer there who does not care about this rebalancing at all. While New York argues about rebalancing, there is a buyer in the East who doesn't care about any of this. No algorithm, no calendar, no target weights, only physical demand. The key does not lie in the price on your screen, but in the difference between markets, between New York and the Shanghai Gold Exchange. Right now, silver in Shanghai is trading at a massive premium compared to COMEX, several dollars per ounce. What does that mean in physical terms? An ounce of silver is worth more the moment it crosses the Pacific. This is not a rumor. This is arbitrage. Buy in New York, take delivery, sell in Shanghai, over and over again until the vaults are empty, and this is exactly where the bank's plan breaks down. Because what happens if the BCI rebalancing pushes the price down in New York? The spread widens. A drop from $80 to $72 does not make the trade less attractive. It makes it irresistible. Every dollar down is a discount for the largest physical buyer in the world. The brokers think they are creating panic. In reality, they are creating a clearance sale. Every ounce that the passive robots spit out is collected, loaded, and shipped to Asia. And why is China buying so aggressively? Because this is not trading, it is strategy. China controls the majority of global solar production. Without silver, there is no energy transition. They see the same mine data we do, declining output, rising industrial demand, so they laugh when the West sells because a rule book tells it to. This is the China shield, an invisible wall of buy orders under the market. You cannot crash a market when the largest buyer in the world is waiting for a discount. And that is exactly why the short narrative is deadly. Anyone who goes short now is not betting against an index. They are betting against the second largest economy in the world. In the next part, we close the loop. We summarize why this meltdown is staged and what you should do when your phone rings again. Now everything comes together. The panic calls, the rebalancing, the $6 billion, the front-running, the China shield. This is not coincidence. It is a last-ditch rescue attempt, because there is one number that keeps the risk managers of major banks awake at night: 4.4 billion ounces of silver. That is how much paper silver has been sold short. Promises that are not physically backed. With every dollar the price moves higher, this hole gets bigger. And that is exactly why they cling to the BCI rebalancing. It is the only guaranteed event that creates short-term selling pressure. Not to save the market, but to buy time. Time to close positions. Time to spread fear. Time to turn you into liquidity. They hope you'll see a red candle triggered by a robot and mistake it for the end. But it is not the end. It is the conclusion. The passive selling is running out. The robots are almost finished. And when that pressure disappears, the same thing always happens. The ball is released, not slowly, not carefully, violently. The market doesn't just have to rebound, it has to catch up. Above 85, toward new highs, the mines are not fuller. The solar panels are not disappearing. The debt is not disappearing. The only thing that has changed is a line of code inside an index. And code cannot override supply and demand. So when your phone rings and your bank's name appears, do one thing. Hang up, do not argue, do not justify yourself, and above all, do not sell. Do not trade a real asset for dying paper. They need your ounces. They need your shares. They need you. If you don't sell, they have to buy elsewhere. And elsewhere means Asia at much higher prices. This is no longer a trade. It is a wealth transfer from the impatient to the steadfast. Hold the line. Remember the big picture. The rebalancing is winding down. The selling pressure is drying up. The panic is fading. And what remains? Reality. Inventories are empty. Mines are producing less. Industrial demand continues to grow. And the East keeps buying without pause. The market will remember that silver is not an algorithm, not a spreadsheet, not a derivative. It is metal, finite, irreplaceable. Once the last passive seller is finished, there is no buffer left, no protection, no release valve. Then only one thing matters: who holds the physical supply? And that is exactly why this moment is so dangerous for shorts and so decisive for you. Not because the price moves up or down today, but because this is where it is decided who loses their nerve and who ends up owning the metal. If they push the price down to 75, that is not a warning. It is a gift. Because in a few months, no one will even remember this rebalancing, but they will remember who was intimidated and who was not. Stay calm, stay firm, and do not let your future be talked out of your hands. See you on the other side.